This is the last part of partnerships in terms of my presentation on partnerships as a whole, and this deals with what happens if a partner leaves the partnership. So again, what if a partner leaves? Well, we actually allow three methods that can be used. One is called the bonus, no revaluation, the goodwill revaluation, or the hybrid method, which means that we just look at tangible assets, but no goodwill is recorded. So here's a description. More depth. The bonus method, amount paid in excess of that partner's capital account is allocated against remaining partners' capital accounts. Goodwill, the books are first adjusted to fair market value with a proportionate increase allocated to each partner's account. The withdrawing partner is paid based on the balance in individual capital account. The hybrid, we're going to restate the assets and liabilities to fair value, but we do not record goodwill. So now we're going to walk through these examples. Now we have a partnership, has the following balances. We have assets of $200,000, and we have Pam, Bill, and Myra. And Myra would like to leave the partnership but wants $80,000 to cash out her capital account. So what are the journal entries using the bonus method? Well, Myra has a capital account of $50,000. She wants $80,000, which means that she wants to get a bonus of $30,000, which means the remaining partners have to be reduced by this amount based on profit sharing. So what we're going to do is we're going to reduce Pam's account based on 50% of the remaining. So remember, when you're doing this, Pam owns 50, it gets 50% of 80% because Myra's 20% is going away. And Bill is going to get 30% of 80%. And then Myra's capital balance will be taken to zero, and she will get $80,000. Now, what happens in the same partnership? Instead, what happens is Myra would like to leave the partnership and believes that the current fair market value of the business is $280,000. Goodwill is to be recorded, and then Myra would like to cash them out to close her capital account. So, what is the goodwill? So, we're first going to record the goodwill of $80,000, and that's going to be allocated based on profit sharing. And then we're going to close out Myra's account by giving her $66,000, which is her original balance of $50,000 plus the $16,000 that she gets as her share of goodwill. Now let's look at the hybrid method. Now in this example, we have to add additional information, which is there is land that is undervalued by $60,000. And Myra then wants to cash out her account. Well, the first thing we have to do is we have to adjust our tangible assets to fair market value. So in this case, we have to record the additional $60,000 in land and allocate that based on profit sharing, and then we can close out Myra's capital account, which was her original $50,000 plus $12,000, and she gets $62,000. That ends this section on what happens when somebody leaves the partnership.